Welcome to the first edition of The Bulls, the Bears, and You as we navigate what is happening in the economy and also we take a look at investing. And with me to talk about all of this is my panel of financial advisors and experts. And I'm going to introduce them to you now. And they are Carrie Coghill of Coghill Investment Strategies here in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks for joining me once again for the Bulls, the Bears, and You. And let's start with a look at the markets. The first quarter was a great quarter if you're a bull, with the Dow up 5.5%, the NASDAQ up 9.5%, the S&P 500 up a whopping 10%. That, though, was just the first quarter. 2 weeks into the second quarter, the bulls are trying to figure out if there really is a bear down the road that they're seeing. All of the major indices were down after the first 2 weeks, so I'll throw this one open. Michael, I'll ask you to comment first. Is this just a normal pullback that we saw in the first 2 weeks, or is something else happening, do you think?
Yeah, there's a lot to unpack there, Stacey. I think the first quarter you mentioned, I looked at this yesterday. That was the second best quarter in the past 2 decades to start the year, which is pretty remarkable. We saw it towards the end of last year. I think there's a lot of headwinds out there in the stock market. One of the reasons why the stocks have done so well over the preceding 6 months is because the Fed was anticipated to cut rates a bunch in 2024. We came into January with the Fed expected to cut rates 6 times this year. That has been ratcheted down to only 2 now. So if one of the narratives for the market's going higher is an easing Fed, and the Fed is not quite doing that, something might have to give, I think, as we progress forward. Inflation still seems to be pretty high. We're seeing that with oil prices. We're seeing that across the board here. It's not even close to their targeted 2%. So I would even be hesitant to forecast the Fed to cut rates 2 times this year. I think they're keen on cutting at least once. But again, valuations are pretty extended here. So it wouldn't surprise me if we get a pullback in the markets greater than what we saw over the first two weeks to start the year. Or the quarter, sorry.
That being said, from the other side of the coin, understand that we have fewer stocks today than we ever did. Corporate America is buying back billions of dollars worth of their shares every day, practically, and that's creating a supply issue. And as everyone knows, prices rise when the supply is smaller than the demand. And right now, there are people who think, not me, but there are people who think that possibly we're rejiggering how we figure valuations simply because there's fewer shares out there to be owned. I think that's trying to put a square block in a round hole, because I think the math covers it in the end. Right, Kim?
I agree. And I look at this whole problem as a math modeling problem. So, and the market's the weirdest thing. Remember, the market is people betting with their dollars who's going to win and who's going to lose. That's essentially the way I look at a market. And I agree that the Fed has been a driver of these markets, well, for it feels like forever, but really ever since they stopped raising, and we've been in the suspended animation of figuring out what happens next, right? And Michael's right that there was this tremendous expectation of interest rates to be reduced pretty drastically and quickly. That looks like that's off the table. And yes, there are fewer stocks, and people are putting money into the market because of 401ks and just normal kind of buying. But what is really driving this market is anticipation of, are these companies going to do better or worse than anticipated? And is inflation really going to bring an end to the party? Does the Fed have to bring an end to the party? These are all things that you have to look at and then weight accordingly, which brings me back to mathematical modeling. So it depends on whatever day is happening. The market can only really react to 1 or 2 things. And for the longest time, it's been the Fed. And now we have, well, we'll get to this later, but earnings season. So there is a lot on people's minds, and it's showing up in prices of companies, which then show up in the averages of the markets.
Carrie, why don't you wrap this segment up for us?
Well, Kim, I love you, right? And, we work together. You have one of the most brilliant brains, obviously, I think the unfortunate thing and where the thinking is disconnected is that the average investor isn't applying their math models when they're trading stocks. They are applying their emotions. So I think that to kind of tie that together, the importance of what Kim does and the value of understanding the math model is that for us as advisors, it keeps us on track. But the point that I'm really trying to make is the day-to-day fluctuations that we see in the market are based on that. The day-to-day fluctuations are based on some scenario that someone created that's driving people to buy and sell. So, when we look at what Kim is saying, where that helps is it helps investors kind of keep their head on straight and not get caught up in all the emotion of the market. I do want to point out what Frank said about supply demand. It's something that I have thought about and preached about for probably a decade, that you have more investors in the market and you have less available companies to buy. It is supply and demand. So I do believe in looking at valuations and how those models work. And it really isn't right to compare, well, what were valuations in the 70s compared to what they are now? You have to go beyond that. So I think that now anyone who's watched this show knows that I think we as a group never thought the Fed was going to lower 7 times. So, to get some sort of volatility here, the thing that worries me the most is that we just don't let it happen. We need this. We need, economic cycles actually need to happen, because if you don't let them happen, you create bigger problems.
Carrie's right on one point there, Stacey, if you don't mind me jumping in.
Sure, go ahead.
Well, she's right on more than one point, but one point I wanted to comment on, I should say, is she brought up valuations, and I think I'm one who thinks valuations certainly matter over the long haul. They really don't matter in the short haul. But when you're comparing valuations today versus valuations in the 70s, 80s, even 90s, if you look at the S&P 500, the composition of that index today is vastly different than what it was in the 70s and 80s. And so when you look at the S&P 500 that has a price to earnings multiple of 21 times today, that's high. And in the 70s and 80s, it was a fraction of that. That's because today the S&P 500 is dominated by high growth tech stocks. It makes up what, Kim, 25% at least of the S&P 500, something like that. Whereas it was a fraction of that back in the 70s, 80s, and early 90s. So it is not, as Carrie pointed out, an apples to apples comparison there. You need to normalize that for the composition of the index. I still think stocks are relatively overvalued in the US, but again, that certainly does not matter much on a short-term standpoint. It does matter a bit over a 5-year standpoint.
I'm going to ask this question since you brought it up, in my mind at least. If there are fewer stocks being traded and the number of S&P 500 companies that are tech-related have grown substantially, is that the reason for the higher degree of volatility that we've seen? I mean, what has exploded that? Is that online trading? Is it things that people can do on their own? What's caused it?
I'm not 100% sure there is more volatility today than there was even 5 years ago. I think that's just a narrative that we're just living in now, and it seems that way. I have to look into that, Stacey, a bit, but I would imagine that the more companies that actually have positive earnings and growth year earnings are probably driven the volatility of the markets down over the past 5 years. Yeah. I had nothing to back that up at this point. But the fact is that a subset of stocks have done so well over the past decade, and they've become a very big cohort of the S&P 500. We saw that last year with the Magnificent Seven driving the overall returns. It was a very concentrated market. This year, however, the stock market is doing very, very well to start the year, and it's the other 493 stocks that are really helping buoy the stock market. Apple is actually down like 10% to start the year, right? So that's a good sign, I think, for the overall stock market as a whole. The fact that you're not relying on just a handful of stocks, you're now starting to get into broadening out. And the fact that the second biggest name in the world in Apple is actually down 10% on the year, but the market's up. I think it's a good thing. We're not all relying on just these 5 names or 7 names to drive the performance of the markets going forward.
All right, we need to take a quick break here. We'll be back in just a moment. Welcome back to the Bulls, the Bears, and You, as we take a look at the economy and also how you invest. So with this pullback, and depending on what you think is happening, I'll throw this one out, and anybody can jump in when they want to. Is this now a good time to start buying again?
It's always a good time to start buying. Not everything, but there is always a stock that's on sale out there that's misunderstood, that you can see its potential, others cannot, and you have some kind of time frame that's going to allow that company to grow into your valuation or your view of it. So I always reject that there is not something out there to buy.
That being
Yeah.
said, go
Go
ahead,
ahead.
Carrie.
You can go.
No, please. Ladies first.
What I was going to say, Kim refers to buying on sale, which is really important. I also believe that you don't always have to buy on sale. If you see a company and it's going to, you believe in it, it's going to grow. The problem is it may never go on sale. So those things that are really in high demand, that are great companies, sometimes you're never going to get that good entry point, so to speak. So, you don't want to sit on your hands too long. And I want to go back to a point in the last segment that I think is really important for individual investors to understand when it comes to volatility. It feels like there's more volatility because we'd always talk about the market in terms of points. It was up 500 points. It was down 500 points, instead of talking about it in terms of percentages. Because
We don't
500
talk
points
about points,
today-
Carrie, on the show. You shouldn't be talking about points on this show. It's about percentages. Hopefully,
right.
we get that across to everybody there.
Yeah, it is about the percentage moves, not point moves.
And
Or
that's-
why?
That's a huge pet peeve of mine that people talk about it. Even on TV, the market pundits talking about it in points. That drives me bananas.
Why?
Just recognize this pullback we're talking about was less than 3%,
Right.
which is nothing. It's. I'm not even sure it's a pullback. It's
Well, it
and
feels
on
like
that
more
note,
than that.
we had Apple down 10%. I think Nvidia is down about that much as well, and Tesla's down probably more, and yet the market's up or hardly down.
And does that make sense, Stacey? It's really important. We need to get you to understand this.
Oh no. I mean, if I'm not mistaken, when I introduced the program, I went by percentages and not
Yes,
by
you
points.
do. Right.
But as a former television broadcaster, it's much more fun to talk about the dramatic number of points that are used as opposed to a percentage. I mean, most of our audiences out there, a percentage doesn't mean that much, but if they hear it's down 155 points, that gets their attention.
So
So basically, all you guys are saying that it's not necessarily a better time to buy now than any other time. Is that what I'm hearing?
yes.
Yeah, because the reason I bring this up is because in the past conversations that we've had, you've all said something about, well, if there's a pullback, take a look at starting to, either double your position or go into something else. So that's what I was asking, why, if this is indeed one of those times or not.
Well, there's a lot that's moving under the guise of the index, right? So there are companies that are selling off or going up. And I mean, that's kind of my view is I look at the market, I look at what's happening, how it's moving up and down, but it's really the individual holdings that you have that, that you're in charge of, that you get to say who gets to stay and who gets to go. And do we add a little bit more? Do we take some off the table? What are we doing here? Or we do nothing. The average is interesting, but it's the individual stocks movement that should move you to take an action or not.
All right, we'll take a break. We'll be back in just a moment. Welcome back to the Bulls, the Bears, and You. And for those of you who are not professionals, like my panel, I want to talk for a little bit about earnings season. We're in the midst of one right now where companies are reporting how well they did or did not do in the first quarter of the year. It can become confusing at times. As an example, some of the bigger banks last Friday reported better than expected quarterly results, only to see their stock prices decline. So my question, Why? Am I looking at the wrong part of the report? What's going on here? If your earnings are up, your profits are up, but people are selling the stock.
Well, it's all about net interest margins. Doesn't that sound nerdy? Doesn't it sound like something that's buried within some kind of press release? And that's exactly the problem. Net interest margin is what banks do. They borrow money from from people like you putting your money into savings, and you're going to get X amount percent back, and then they lend that out. And the difference between what they borrow and lend at is net interest margin. And everybody kind of made this big assumption that since the Fed is holding steady, that banks would have done well. But apparently, they are not doing as well as it advertised, and it's not going to get, or imagined, we'll put it that way. And it's not getting any better. So, and you get that by listening to the conference call and what the analysts are asking of the company executives, like what's going to happen in the future? What do you see 6 months from now? And people are disappointed in the earnings. So that is how we get, the headline is way different than what happens in trading on the day of an earnings call.
And Kim looks at it. Kim does this a lot, obviously, for what she does on the individual equity names. I personally like to hear about it and think about it from a macro standpoint. And some of the banks that have reported, JP Morgan, Citi, and I mean Goldman today, they are starting to see the consumer become a little bit more pinched. I think delinquency rates have picked up for American Express in their earnings. I saw that. So maybe not all super rosy underneath the surface there from a consumer standpoint. The consumer's been so strong for the last few years, and the markets deal in rate of change terms. So are things getting better or are things getting worse? That to me would probably be one of the signals I'd be looking for as we progress into 2024. Is the consumer getting better or worse? Are unemployment numbers getting better or worse? And that's something that is certainly going to pique my interest as earnings progresses in 2024.
Look, I have to interrupt and ask you, Michael, how do I, as an individual investor, determine whether things are getting better or worse? What should I be looking at?
You can look at jobless numbers that come out and the unemployment numbers that come out very frequently. And consumer confidence is another good one that's issued by the University of Michigan. Those are very easily, Google those. I was trying to think of the adjective to do there, but you can certainly Google those and you can see what those data points look like.
Call research and find your way to research it, I guess,
Yeah.
maybe.
Fun times. Yes.
Let me add something to that question, Stacy. Most people need to first measure what their objectives are, what their time horizon is. If you're a 30-year-old person that's saving money for their retirement, today's news is rather irrelevant. You have to ask yourself a question. Do you believe the world economy is going to grow or not? If you believe the world economy is going to grow, own stocks. Buy an index. Buy a mutual fund and let them manage it. Give the money to Kim and let her manage it. Or Carrie will give some of your money to Kim and let her manage it, and along with other things. And don't get bogged down in the day-to-day news, because you're not trading, you're investing. Trading is what we'd like to talk about because it's fun. Understand, fun isn't how you make money. Discipline is how you make money. And if you're disciplined with what you're doing and you stick with your discipline until it's proven wrong, then go with it. It's not unlike a football coach who develops a game plan. He stays with it until he figures out it's not working. Then he makes adjustments. And that's what you do with investment portfolios. You start with a game plan. You know the target's going to move. And as it moves, you adjust. And it's the day-to-day news is really not that important as long as you believe the world economy is going to continue to grow.
Yeah.
And that's
Yeah.
what, go ahead, Carrie.
I was going to add that, when we look at these companies and earnings, and especially with the banks, we're getting a lot more focused on other things besides the net interest income. But it's really not just with the banks, but every company, the impact now of higher inflation. And, some of these banks, particularly the regionals, we have been seeing non-interest expenses increase. the technological needs of these companies and their needs to purchase and upgrade technology is costing them a lot more. And with the banks, their loan portfolios. And we're watching what's going on in the commercial real estate market, and a potential looming crisis with office space. And some of these banks aren't really well diversified. So it is important to kind of know what you're looking at. It's funny when you ask the question about, how does the average investor get a feel for what the economy is doing? And there's a lot you can do in your regular life. You go to Ross Park Mall or any mall. Can you find a parking spot? Can you get a restaurant reservation? There are simple observations that you can make. There was an article, I believe it was Wall Street Journal, something last week, that talked about the United Way has this 211 line, which is the helpline. People that are having financial challenges call, and they are trying to get assistance from various places. This 211 line has been a really good predictor of the economy because people were calling, very early on in the financial crisis saying, I need help paying my mortgage. And now what's happening is they're getting calls with other basic needs that they are having trouble keeping their head above water. The shame of it is that, the poverty line is so low in this country that a lot of these people are shut out from assistance, which again goes to the book Wealth of Nations and Adam Smith. And are we really staying true to capitalism and treating our employees, the way they deserve to be treated? That's for another day.
Well, no, but that's part of this, because if we're talking about how well a company does, if I'm not mistaken, there's much greater pressure right now on companies to raise wages because of inflation. I mean, and then we start getting into a never-ending cycle, it would seem. Am I wrong on this observation?
Well, you're not wrong, Stacy, but the problem is more for companies finding qualified people to work for them. And in order to get them or steal them from someone else, you have to pay them more. And it's one of the reasons we have inflation. The cost of employment has risen underneath. Now that it's fortunately, for now at least, measured out that its wages are rising faster than inflation, which is a good thing, which gives me some hope that maybe we're not going to fall off a cliff here too soon. Along with my retired friends have much more income today than they had 2 years ago because interest rates rose, and they're able to do things that they couldn't do before because they have more interest income. So all these things are positives, and corporate America is getting demand from all of this. For the retired people, that's the restaurant problem.
All right, well, let's take a break. We'll be back in just a moment. Welcome back to the Bulls, the Bears, and you. And today, of course, is the day that you have to file your tax return. So what better day to begin a discussion that will be ongoing on what you should be doing now in preparation to perhaps lower your tax burden for the next year. Frank, I know you love to pay taxes. So why don't you start this off?
Today is my favorite day. If I look a little disheveled, it's because I am.
Yeah. Okay. Are there strategies that you can start to put into effect now for at this date next year?
It's way too late. My father was a CPA, and I remember him telling a new client who walked in on January the 4th, and he said to him, well, this is when I worked for him when I was very, very young. And he said, well, you have an option. You can call me before December 31st, and I'll be a doctor. If you call me after December 31st, you can consider me the undertaker. So at this point in time, the work has been done. The only thing I think that's left that could be done, if you haven't, is contribute to an IRA if you qualify to do so. And that being said, right now you fill it out, you write your check, and move on.
All right. Well, this goes into then what a lot of you have done or do right now, and that is, do you sit down with your clients and talk about tax strategies? And you know, is it a 1 year strategy? Are you looking 5 years, 10 years down the road? How does this work?
It's ongoing.
Yeah.
Yeah, we
Yeah.
do that a bunch at Fregasso, where the financial planners do a ton of that stuff in terms of, let's focus on charitable giving. That will reduce your tax bill. Let's focus on what Frank said. We can move some money into an IRA and then do it back to our Roth IRA. Stuff that's sort of not in my realm of expertise at all. And then on the portfolio management side, this is something I know Carrie does throughout the year as well, is we constantly look into our clients' portfolios anytime there doesn't even need to be a pullback. If you manage individual equities, the market can be doing very well, but as we discussed, Apple's down 10%. So we're constantly loss harvesting positions in our client portfolios to build up losses that can offset future gains in their portfolios. So eventually, when you do need to take money out of your portfolio, you hope to not pay any capital gains tax. That's the whole goal of being very, very tax efficient when you're managing portfolios in taxable accounts.
I will say this, capital gains tax for most people is 15%. And that being said, although we all do what Mike is suggesting, I added an additional thought onto that in, do we really want to not own whatever we're tax harvesting? Because you're not going to own it for 31 days. And you can buy it back after 31 days, but there's a risk in there. One way to mitigate that risk is to buy it first, double your position, wait 31 days, and then sell the original position so that you're not out of the position if you love the stock. For instance, if you bought Apple 3 weeks ago, 10% higher than where it is, you might want to harvest that loss, but you might want to buy the Apple first and sell it later. And this way you're not out of it, because now that it's dropped, maybe it makes sense to buy it.
Yeah. And those kinds of strategies you really want to check with your tax advisor, because it can get tricky. The buying and selling of the same security around that, those 30 days, there are definitely some nuances to that. But, to Frank's point, you're going to be out for 31 days. So what do you want to do? Do you want to go in, if you want to sell Coke, do you buy Pepsi and stay in Pepsi just to have the sector exposure? So when we're doing it with stocks, we are looking to put it into either a comparable ETF. If we're selling Apple, maybe we go into an ETF, and, hopefully we have a bigger problem at the end, because now the ETF might have a gain if we sell it. Now, Stacey, back to your question earlier, with the markets being, volatile to the downside, is there something that you should buy? I would say it's a valid question on the other end. Is there something you should sell? And, one of the things right now is we are looking at, the fact that inflation has remained more elevated than the Fed would like. Is now a good time to be shortening your duration on your bond portfolio if we think that inflation is going to stay at this level? So we can take some losses potentially with those longer term bond portfolios and get them into an intermediate position, which isn't going to have the same amount of volatility. So that's really where the economic data does impact what we're doing on the tax side. And
if I can interrupt him before you go, Kim, here. And so this is ongoing through the year. I mean, a lot of people have a tendency to try to wait until, December and decide to do something.
At a minimum, I think you should discuss what gains are kind of you would like to see out of a portfolio at its most, right? Like what kind of gains can you take as a taxpayer? And I think that's really important to discuss with your advisor and make sure that it isn't a surprise at the end of the year.
Yeah, we really shoot to have a tax capital gain budget for everyone. And to your question about, is it to plan for a year, 5 years, 10 years, it depends on the client. Because if we know that we have a client that's selling the business in 5 years, we're already starting to strategize about how we can minimize those taxes. So it is ongoing. I would say that we spend as much time tax planning as we do investment planning.
Interesting. Well, we will continue our look at taxes and how you can handle your investing in future editions. But for right now, thank you for joining us, and we'll see you again in about 2 weeks or so.